What is going on, traders? The Treasury just announced a buyback program. This is not something that happens often. Now, you might be shaking your head, rolling your eyes, wondering what the hell is a Treasury buyback program? You might be familiar with Fed quantitative tightening, which is rolling assets off of the balance sheet. But what is a Treasury buyback program? Isn't the Treasury the institution that issues treasuries? How can they be buying back treasuries? The real question is, why are they doing this? Obviously, this is an anomaly. This is a very weird mechanism that the Treasury institutes. The last time that we saw this was actually in the year 2000, and the time before that was right before the Great Depression. So not in great company here. In this video, we're going to go over why the Treasury is panicking. Why are they instituting this buyback program? What is it? Why you should be worried about it? How does it fit into this backdrop of now finally we're getting the unemployment rate rising? We're getting much less than expected job growth. This is definitely trending in the way that the Fed wants. The likelihood that the Fed doesn't even institute a rate cut this year. Jerome Powell's last testimony at the FOMC on May 1st basically said that inflation is currently winning the fight between them and the Fed. And obviously, you guys come here for the trading and investing. How is this going to affect stocks in my view? And how does this change things from my investment perspective? Let's get right into it. So as I said, the Treasury just announced its buyback program. This is going to start in May. And like I said, this is not very common. As a matter of fact, I was looking at this research paper on Treasury buybacks. They first experimented with this in the 1920s, right before the Great Depression. Then they brought it back in March of 2000. Like I said, we had recessions in both of those times. Now, the reason they do it, they just call it general cash management. But the real reason that they do it is twofold. One is because the government's tax payments are getting very hefty. I'll explain what that means in a second. And two is to try to tamp down the yield curve, which has been inverted for, I think this is the longest time in history, 500 days or more, that the 10-year, 2-year yield curve has been inverted. Now, the reason that this is insane is because the Fed is trying to roll assets off of their balance sheet. These are treasuries, largely treasuries here. So quantitative tightening is how we are one of the ways in which we are trying to control inflation, by sucking all of that money that we printed after the pandemic, all of this money, $4.5 trillion that we printed, sucking that out of the economy. And we do that by the Fed saying, okay, we're not going to be buying any more treasuries. We're going to let these expire. And that is going to suck the money out of the banks, out of the banking system. And we get to try to control inflation. This along with higher for longer rates. So if the Fed is trying to cut assets off of their balance sheet, what the hell is the Treasury doing? Doing buybacks of treasuries and potentially triggering an inflationary event. Well, let's talk about the government's tax payments first. Well, what the government is trying to do is they're trying to lower their debt burden because they issue treasuries to the public and they have to pay interest on those treasuries. When yields spike, well, what happens to the government's interest payments? They're going to have to pay interest payments up the wazoo. And if yields continue to spike, because as Jerome Powell said, the fight with inflation has stalled, and because of what is going on in Japan, which I will talk about in a second, the Treasury is trying to control yield. So here it says the Treasury is likely to buy back shorter dated debt, mainly around major tax payments. Essentially, what the government wants to do is they want to buy back higher yield debt, replace it with lower yield debt so they can reduce the burden on their humongous tax payments. Now, while doing this, they also get to try to control the yield curve because right now the higher yielding debt are the shorter term yields. Remember, the yield curves are still inverted because this is what we typically see pre-recessions. The bond market always signals trouble ahead of the stock market. So when you look at the higher yield debt, it's the short-term yields. And so that is what is inverting these yield curves, is that the shorter term debt is offering more yield than the longer term debt, and the government is trying to fix that. The only problem is that we have a huge fight with inflation on our hands. And so part of the reason that yields are spiking is because the Fed is no longer buying treasuries at the rate that they used to, and also because Japan's currency is in the toilet, and Japan is by far and away the largest purchaser of US treasuries. So allow me to explain really quick with one of my Khan Academy drawings. Here we have the US Treasury, represented by a big T, right? Now, they issue treasuries, which is basically how money is printed. So they're issuing these treasuries and they say, hey guys, if you give us money, we promise to pay you back with interest at a later date. Please buy these treasuries. And here we have the Fed, right? And the Fed is saying, hey, we need to control inflation. So, all these treasuries that we're holding, well, we are going to dump them on the market as well, or, roll off treasuries off the balance sheet, not buy more treasuries, etc. Same thing, meaning that this basically leads to an oversupply of treasuries because the Fed is no longer a customer. So you have the Fed no longer buying treasuries, leading to an oversupply of treasuries. You have the Treasury issuing treasuries, and you have countries like Japan, which I'm going to do a whole video on Japan, but let's just say right now, for simplicity's sake, you have a country like Japan, who is the largest purchaser of U.S. treasuries, saying, hey, our currency's in the toilet. We can't really continue to purchase U.S. currency, right? Essentially, we can't continue to purchase U.S. currency, which is propping up the dollar and devaluing the yen. We need to come up with ways and intervene in order to strengthen the yen, which means that we cannot buy U.S. treasuries at the rate that we used to, or else the yen will continue to tank. So all of these treasuries that hit the market, what do you think is going to happen to yields? Well, in order to attract investors, this is why bond yields go up when the supply of treasuries go up, right? Because it has to attract investors. And if investors start gobbling up treasuries, that's when yields go down. But there are so many avenues in which treasuries are flooding the market or could flood the market that the Treasury is terrified, and the U.S. government is terrified of these rising yields, which would put not only more pressure on the U.S. economy and the U.S. consumer, making things more expensive, but also would put a huge burden on the government's tax bill, right? Because remember, they're paying this interest. So now the Treasury is saying, okay, we'll just go ahead and start buying back these treasuries. And again, you now have conflicting interests with the Fed, because the Fed is like, no. We shouldn't be buying back treasuries because that is inflationary. And the Treasury is saying we have no choice, because if we don't, yields are going to go crazy. And now we are finally seeing higher yields affect the market, although this is not enough data, in my opinion. We need way more data to show that the high yields are affecting the market. And this is why it's so hard, and I would say impossible, to achieve a soft landing when you have rates, when you have rate increases like this, when we are fighting this type of inflation, which, by the way, I don't know if you guys saw this. This is kind of infuriating because no one's going to get punished for this. And this is just a side note that we don't really have to focus on in this video. But Larry Summers said that if we're using the old calculations, the inflation actually hit 18% in 2022. None of you are surprised, I'm sure. There's no way we're going to the grocery store paying $12 for eggs, and they're telling us, oh, inflation is at 8%, and it's growing at a lesser rate because this month it's 7%. Like, we all knew that it was at ridiculous numbers. If the government did not change the way that inflation was calculated, that's probably a topic for another video. So all that is to say that these are all things that, the Treasury buybacks, the now rising unemployment, the insane decline of wage growth that we are now seeing, finally the steepening of the yield curve, although it is not uninverted yet, the precipitous decline in home prices. These are all things that we tend to see before a recession. Now, you might say to me, as always, well, why do you keep talking about the stock market? Why don't you just sell and, never look back until a recession hits? Because the reason, and I've mentioned this time and time again, is because a recession is one of the hardest, if not the most impossible things to predict. And literally every human being on the planet, including me, are terrible predictors of timings of a recession. And by the time a recession hits, the stock market can continue to make highs. Also, I'm not scared because of this one simple fact. I know that in the last few recessions that we've had, where they were rate hike, where we saw an increase in rate hikes when we were on a rate hiking cycle, the first time that the Fed cuts is the signal to get out of the market. January 2001, the first time that the Fed cut after the 2000 rate hikes, that was right here, and we then suffered a 50% decline thereafter. September 2007 was the first rate cut, right before the financial crisis. September 2007 was literally the peak of the market, right? Before suffering a 50, 60% decline in the stock market. So for me, I am not really panicking until the Fed actually has a reason to cut, and the Fed is not just going to cut for no reason. Think about it, right? This is the Fed's only tool practically. So they cannot cut before the war with inflation is won. So could we revisit all-time highs on the SPY? Yes. Could we make new highs? Yes, sure. You know, if you look at the stats of since World War II of the average bull market, I mean, you could see that this bull market here that started in 2022 is pretty young at 18 months. Although I would argue that since the pandemic, this time is slightly different than the times that we saw previously, where it was the age of easy money and we had these insane bull runs here because the Fed and the government figured out that there were easy ways to provide liquidity to the system, right? And we are now reeling from those effects here. So I would argue that with peak rates, with the Fed trying to take money out of the system, that we're not going to see, at least in this cycle, a bull market that lasts this long here. But you guys know my position because of everything that I talked about and the fact that we're at peak rates. I'm not excited to buy the NASDAQ or the S&P 500 here. Sure, if we get a 10% decline or more, then yeah, I always add at those levels anyway, regardless of what is going on. But in my view, as I said, it is a stock picker's market, right? Stocks like Google, which we bought after the overreaction to their AI back in March, when it hit 130, it looked like the cheapest stock out of the Mag 7. Hit a high of 175. Stocks like Tesla that I said you can wait until earnings in order to buy. After earnings, it did hit a low of, I think it was like 139. I ended up buying it at 145 or 146. When Apple hit the mid 160s, we bought Apple as well. Apple surged to a price of 187. These are the types of asymmetrical bets that I'm looking at. And if you don't believe me, here you go. Here's my post from March 5th. Next buy on Apple is at 165. Here's my post from March 7th on Google saying that I was buying here and it was at 135 then. Here's my post from March 11th talking about my price target for Tesla being 152, as you can see here. And to be honest, guys, I'm not the type that is actively buying stocks every day. Like, I'm very deliberate about my purchases. So you can see those last few stocks there. Those were asymmetrical bets, right? Beaten down Mag 7 stocks. It's not like I was buying Nvidia at 900. Other than that, I continue to be a buyer of the VIX at 13 and below. That is what I've been hedging. I did that maybe 4 times this year. I also told you guys that what was going on between Israel and Iran wouldn't amount to nothing, and that the minute that there's a retaliation, I'm going to be shorting the VIX, which ran up all the way to 21. And I'm going to continue to day trade what the market gives me in terms of price action on a daily basis. I'm still of the mind that we hit a recession. I'm still of the mind that something is going to break, whether that is in commercial real estate, whether it's Japan that's going to bring us down, whether there's going to be some sort of repercussions from the heavy interest payments that the government is paying. I don't know what that is. I don't know when that is, honestly. If you want access to all of our trades, all of my day trades, my swing alerts, like Google, Apple, Tesla, make sure that you subscribe below, sign up, use the coupon code that you see in the description below. Honestly, at this point, I'm being cautious here while picking my spots. Like I said, if the indices drop 10% or more, I'll buy them regardless. Leave a comment down below. Let me know if you think that we are recession bound. Let me know if you actually think we're going to hit a soft landing. I would love to hear from you and why that is. If you do think we're going to hit a recession, let me know what you think the catalyst is going to be. And make sure you tell me what you think about the Treasury buyback program. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.